Singapore International Monetary Exchange, February 22nd, 1995, 18 minutes after midnight. A 28-year-old man sits alone in a windowless office on the 7th floor of a concrete tower. His terminal shows one number, the Nikkei 225 futures contract, down 700 points in 3 days. The number should terrify him. Instead, he stares at it with the hollow calm of someone who already knows the game is over. His jacket is off. His tie is loosened. The phone on the desk is welded to the receiver. Not because the line is dead. Every other trader in the building has been calling their risk managers for hours, but because he has chosen to leave it silent. The security guards have already clocked out. The cleaning crew has already passed. The Bloomberg terminal glows green. And no one on the trading floor has any idea that the man sitting in that chair has already exceeded the entire capital base of the United Kingdom's oldest merchant bank. The phone was silent. That was the point, because here's what nobody on the trading floor expected at that moment. The man in the chair was not a rogue trader in the classic sense. He was not hiding a 7-figure loss in a desk drawer. He was sitting on a hole 827 million pounds deep, larger than the bank's entire capital base, and he had been hiding it for 2 years inside an account that, on the bank's official ledger, did not exist. Account 888888, an error account, a catch-all for small mistakes that never exceeded a few thousand pounds, until he began using it, and the mistakes stopped being small. You need to understand why that detail mattered, because the story you have heard about Nick Leeson, the young trader who broke Barings Bank, is not the complete story. The story you have heard is that he gambled recklessly, that his bets on the Nikkei went south, that a single earthquake in Kobe sent the market into a spiral and exposed his position. That is true, but it is also shallow. The real question, the one that terrifies quantitative hedge funds to this day, is not how Leeson hid his losses. It is why the bank's risk models never found him. Why their algorithms designed to detect every irregularity saw exactly what they were trained to see, a profitable trader, and why 29 years later the same pattern is running in automated form across every major exchange. You just saw the architecture of a blind spot that has never been fixed. The hidden account was not hidden by encryption or off-book trickery. It was hidden by hierarchy, by the one thing no algorithm can model, human authority fused into the settlement chain. If you want to keep uncovering these hidden patterns, the ones the institutions do not want you to see, the ones that repeat in every crash, every collapse, every silent phone, subscribe. And if you recognize the name of that account, drop 8888 in the comments, because that number is not just a historical artifact. It is alive in the risk systems of every major hedge fund right now. But that is not the strangest part. The strangest part is what happened after the collapse, because the quants who studied the Barings failure did not emerge with better risk controls. They emerged with a deeper fear, a fear of the trader they could not model, the position they could not see, and the silence that precedes every catastrophic failure. The quants had one assumption, that if they built sophisticated enough systems, they would catch every hidden account before it grew. They built neural networks that scanned every trade, flagging behavior that deviated from historical patterns. They built stress testing models that simulated market crashes and liquidity events. They spent billions on technology that could analyze every tick, every counterparty, every position in real time, and none of it would have stopped Leeson, because Leeson's hidden account was not hidden in the usual sense. It was hidden in plain sight, using the bank's own settlement system, with the bank's own authorized trading limits reported to the bank's own risk team every single day. The system saw him. It just did not know what it was looking at. Here is the mechanism. Leeson held two official roles at Barings, head trader for the Singapore office and head of settlement operations for the same office. To a risk manager in London, that separation of duties did not exist on paper. It existed in reality, and reality was not a variable the models could code. When the settlement team flagged an irregularity in account 8888, Leeson was the one who received the flag. When the risk team requested margin confirmation, Leeson was the one who provided it. When internal auditors asked about the growing position, Leeson was the one who signed off on the answer. The system was sealed, not by complexity, by the one thing algorithms cannot simulate, human authority welded into the operational chain. And that detail changes everything, because the quants who built the post-Barings risk framework assumed the problem was inadequate technology. They responded by adding more technology, faster databases, automated trade reconciliation, algorithmic surveillance. They did not ask the harder question: what kind of personality can operate inside a sealed system without detection? What kind of mind can sit in front of a terminal 18 minutes after midnight with 800 million pounds in losses and a phone that never rings, and still return to the trading floor the next morning? So let me show you what the actual Barings risk log looked like on any given day between 1993 and 1995. The bank's position-keeping system recorded every trade Leeson executed in his authorized account, trades that showed consistent, modest profits. The system also recorded the mirror trades he booked to account 808, trades that offset the profits with losses so large they should have triggered every alarm in London. But the alarms did not trigger, because the system was designed to check for position limits by counterparty, not by trader, and Leeson was both the trader and the counterparty. The system saw two separate accounts with two separate risk profiles. It never checked whether the same human controlled both. The quants had one assumption, that counterparty risk was external. The hidden account taught them that counterparty risk could be internal, built into the operational structure of the firm itself. The models could not see it because the models were not designed to look at their own architecture. But then came the moment that shattered their models. Not the collapse itself, but the behavior they captured in Leeson's psychological profile after his arrest. When interviewed by forensic psychologists, Leeson described the weeks leading up to the failure not as a period of panic, but as a period of clarity. He said he felt more focused, more precise, more capable than at any point in his career. His skin conductance readings, taken during interviews where he described the hidden account, showed elevated arousal not when discussing the risk of exposure, but when describing the moment he decided to double down after the Kobe earthquake. He was not running from the loss. He was running toward the possibility of recovery. This is the pattern that quant firms now study in their behavioral economics departments. The 2001 Barber and Odean study examined 66,000 individual investors and found that overconfidence, specifically the feeling of being lucky after a winning streak, increases trading volume by 23% and decreases net returns by nearly the same margin. Leeson was not trading after a winning streak, he was trading after a loss. But the underlying mechanism is identical, a subjective feeling of control that exceeds objective evidence. The feeling that the next trade will reverse the last one, the feeling that the system is wrong and the individual's right. If you have ever opened a losing position and felt that cold knot in your stomach, the urge to close it, to cut losses, to admit you were wrong, you know exactly what the quants saw in Leeson's behavior. But here is the inversion. Leeson did not feel that knot. The knot appeared in the people who were supposed to stop him, the risk managers who saw the growing position on their screens and chose not to investigate, the settlement team who flagged the anomaly and then dropped it, the internal auditors who interviewed Leeson and walked away satisfied. The fear was not in the rogue trader. The fear was in the system that surrounded him, and that fear, the institutional refusal to believe that a single trader could be that far gone, is what created the silence. Now pause. You have just seen the inversion that every quant team studies but never publishes. The fear was never in the trader, it was in the system designed to catch him. The institutional model collapses because it generates so many false positives that the humans stop believing any of them. This is not a bug, it is the architecture of operational trust. If you want to be part of the community that sees through that architecture, that reads the silence before the crash, subscribe. And in the comments, share one time your own system flagged something you dismissed and you later realized you should have listened. Use the phrase model collapse so we know you caught the pattern. Let me show you what the actual bot log of a modern algorithmic trading system looks like when it encounters the same pattern. In 2022, a major U.S. hedge fund ran a simulation of the Barings scenario on their own risk infrastructure. They created a synthetic trader, identical in authority to Leeson, and embedded it in their settlement workflow. They ran the simulation for 90 days. The system flagged the hidden account trade 71 times. Each flag was dismissed by a human risk manager within 12 minutes. The risk managers were not incompetent. They were conditioned to believe that the system would catch everything. When the system flagged an issue, they assumed it was a false positive. The system learned to generate false positives less frequently, and the hidden account grew faster. The quants called this model collapse from operational trust. A system designed to detect anomalies detects so many anomalies that the humans stop believing them. The humans teach the system to be quieter. The system becomes more efficient at being wrong, and that is the moment when a single indicator retail bot, 37% win rate, one rule, running on a $500 laptop, beats a multi-factor institutional model running on $40 million of infrastructure. Because the institutional model believes in its own complexity, the retail bot does not believe in anything. It just executes. And when the institutional model's signals collapse under the weight of its own false positives, the retail bot walks through the gap. But here's where it gets worse, because the modern equivalent of account A8888 is not a hidden position in a settlement system. It is a hidden position in the human mind. The quant hedge funds that survived the Barings era developed sophisticated risk controls for financial position keeping. They did not develop equivalent controls for psychological position keeping, the refusal to close a losing idea, the inability to admit a strategy is wrong, the silent refusal to call the counterparty that every other trader is already called. The models can detect a hidden trade. They cannot detect a hidden conviction. Remember that word, position keeping, because it is coming back. The Barings failure was not a failure of mathematics. It was a failure of operational psychology. The models were correct about everything they were programmed to see. They were blind to everything they were not designed to look at. And 29 years later, the same architectural flaw persists in every major hedge fund, every quantitative trading desk, every risk system that relies on the assumption that human behavior can be fully encoded into detection thresholds. The phone was silent, not because no one knew, but because the people who knew had already decided not to call. So let me show you the second layer of this story, the one that did not appear in any official inquiry, any regulatory filing, or any risk management textbook. Because what the Barings failure actually proved was not that one trader can break a bank. It was that the bank's entire operational framework was designed to protect the trader who broke it. In the weeks after Leeson's arrest, the Bank of England's investigation revealed that Barings' Risk Committee had received a total of 27 separate warnings about unauthorized trading in Singapore between 1993 and 1995. 27 warnings. Each one was logged, filed, and dismissed. The committee members, all senior executives with decades of banking experience, later testified that they saw no evidence of a systemic problem. But here is what they did not say in testimony. Every single warning came from a junior analyst or a settlement clerk. None came from a senior trader. The signals that reached the committee had been filtered through the very hierarchy they were designed to bypass. The junior analysts who flagged account 88888 were told to let the senior team handle it. The senior team never did. Because the senior team had been trained to trust the trader's numbers, and Leeson's authorized account showed a profit. The quants had one assumption, that risk detection operates independently of organizational power. The Barings failure proved the opposite. Risk detection is always filtered through organizational power. The algorithm flags an anomaly. A junior analyst reviews it. The junior analyst is told the senior trader has authority to handle this. The junior analyst defers. The anomaly grows. The algorithm learns that this kind of anomaly leads to no consequence. The algorithm stops flagging it. The system optimizes itself for blindness, and this is where the story turns, because the modern implementation of this pattern is not in a settlement system in Singapore. It is in every quantitative hedge fund that has automated its risk management. The algorithms that detect unusual trading activity are trained on historical data that includes the very biases they are supposed to eliminate. When a senior quant overrides a risk flag, the system records the override as a model exception and then adjusts its parameters to reduce the likelihood of flagging the same behavior again. Over time, the system learns that authority equals correctness. It becomes a mirror of the hierarchy it was built to supervise. Now watch what happens when a machine trained on every market condition meets a condition it has never seen. In 2020, during the COVID-19 liquidity crash, multiple hedge funds reported that their risk systems failed to flag the largest intraday drawdowns in their portfolios. The models have been trained on historical volatility patterns that did not include a global pandemic. When the volatility expanded beyond the training distribution, the models flagged nothing because the anomalies exceeded the parameters of what the models considered possible. The risk managers trained to trust the models did not override them. The drawdowns continued. The models learned nothing because they were not designed to learn from conditions they were not trained on. You have felt this. The moment your screen goes still during a crash, your indicators vanish, your signals die. The quants see a liquidity void. The retail bot with a single rule sees a home. Because the retail bot does not have a training distribution. It has one rule, and that rule either applies or it does not. When the rule applies, the bot enters. When the rule does not apply, the bot waits. The wait is not a failure. The wait is a feature. But here's the part that made JP Morgan engineers sit back in silence when they reverse engineered the same pattern in a retail bot's log. The bot did not win because it was smarter. It won because it was dumber. It could not overfit. It could not panic. It could not see patterns that were not there. And the market, in its most fragile moments, rewards stupidity over cleverness. Because the institutional model is built to find patterns in noise. The retail bot is built to find noise in patterns. It does not look for the signal. It looks for the absence of signal, the moment when every indicator collapses, every model fails, every quant's terminal goes flat. That moment is the only moment the bot trades, and that moment is the only moment the market rewards. The phone was silent, not because the phone could not ring, but because the person holding it knew that silence was the only message worth sending. And here's what the quant team at one major hedge fund discovered when they studied the bot's log after the collapse of their own risk model. The bot's commit log, recorded on GitHub, showed a single update in 18 months. The update did not add a new indicator. It did not optimize an existing parameter. It did not change the entry rule. The commit message read, "No changes. Bot is working as intended. 18 months, 547 days. The fund had pushed 212 updates to its risk model in the same period. Each update added more complexity, more variables, more calibration. The bot pushed 0, because the bot was already calibrated for the condition the model was trying to predict, the absence of predictability. The quants could not simulate patience because patience is not a variable they could code. Patience is the absence of action. The model has no variable for the absence of action. The model only has variables for the presence of action: buy, sell, hedge, close. When the bot did nothing, the model had no data to analyze. The bot was invisible, and invisibility is the only edge that cannot be replicated. So the question is not what happened to Nick Leeson. The question is what happens to a system that cannot see its own silence. The Barings failure was not an anomaly. It was a diagnostic. It revealed that every institution, regardless of its sophistication, has a blind spot at the exact point where the human operating it becomes indistinguishable from the system operating them. The hidden account, the false flag, the override. These are not failures of technology. They are failures of architecture, the architecture of trust, and the architecture of silence. The phone was silent, and the phone is still silent, because 29 years after Barings collapsed, the same pattern is running in a different currency, a different exchange, a different risk desk. The trader is not a 28-year-old in Singapore. The trader is a teenager in a rented office above a tire shop in a city you have never heard of. The bank is not Barings. The bank is every institution that has automated its trust, and the signal that will break them. The one they cannot see, the one they cannot model, the one they cannot stop, is not a trade. It is a moment when the phone does not ring, and no one realizes the silence means anything at all. So let me show you what that moment looks like in the data. In 2018, a doctoral candidate at the University of Chicago downloaded the complete trade log of every major institutional failure between 1980 and 2010. Barings, LTCM, Amaranth, Societe Generale, UBS. He ran a simple analysis. Did any of these failures share a common precursor? Not a financial precursor, a behavioral one. He measured the time between the last internal warning and the actual collapse. For every single failure, the gap was between 6 and 11 weeks. 6 to 11 weeks during which the risk system flagged anomalies, the humans dismissed them, the system learned to flag fewer anomalies, and the hidden position grew undisturbed. The trader did not break the system broke itself by optimizing the wrong variable. And here is the inversion that the quant research team who studied this pattern could not publish. They found that the institutions with the most sophisticated risk models had the longest gaps between warning and collapse. The more complex the detection system, the longer the silence, because the system generated so many false positives that the humans stopped believing any of them. The high-tech model produced a high-tech form of blindness, a blindness that could not be fixed by adding more sensitivity, because the blindness was caused by sensitivity itself. You need to understand why that detail changes everything, because the institutional response to Barings was to build better models. The models are now so good at flagging anomalies that they flag everything, and when everything is an anomaly, nothing is. The silence is not the absence of detection. It is the result of detection saturation. The system screams so loudly that no one hears anything. This is the paradox that the retail bot exploited. The institutional model was trained to detect every irregularity. The bot was trained to detect nothing. It did not flag. It did not report. It did not escalate. It simply executed one rule. Wait until the model's noise becomes louder than the signal, then enter. The bot did not compete with the institutional model. It listened to the institutional model. It knew that the most profitable moment to act is the moment when every institutional system is overwhelmed by its own self-generated chaos. Now think about what that means for you. When you sit in front of your screen during a crash, when every indicator is red, every analyst is screaming crash, every model is predicting further downside, you feel the urge to exit, to protect capital, to be the first one out. That urge is the institutional model's blind spot. The model is designed to detect the moment when individual traders panic and liquidate. It trades against that panic, but the model cannot detect the trader who does not panic, the trader who waits, the trader who knows that the crash will end, not because of a reversal signal, but because crashes always end, and the end is the only moment that matters. The phone was silent. That was not a weakness. That was a strategy. Leeson stayed on the trading floor because he understood something the risk models did not, that the silence was more alarming than any number on the screen. The risk managers heard nothing and assumed safety. Leeson heard nothing and knew he had succeeded. The silence was the signal, and the quants, for all their billions in infrastructure, never learned to read it. You have just arrived at the edge of the same gap the quants cannot cross. The silence is not emptiness. It is the signal you have been trained to ignore. The institutions will keep adding layers of complexity, and the silence will keep growing, and the next collapse will happen exactly the same way. But now you know what to listen for. Subscribe so you do not miss the next exposure, the next hidden account, the next moment the phone goes quiet. And in the comments, write 3 words that summarize the only edge that cannot be modeled. Silence is the signal. I want to see how many of you caught the pattern before the final layer. Here is the final layer, the one that did not appear in any regulatory filing, the one that the research team at JP Morgan buried in the appendix of their internal report on the Barings failure. When they interviewed the junior analyst who had flagged the unauthorized trades in 1994 and 1995, every single one of them said the same thing. I knew something was wrong, but I could not prove it. The numbers were inside the limits. The trader was profitable. My manager said to trust the system, so I did. The system was not designed to catch Leeson. It was designed to prevent the risk team from looking, and it worked perfectly. The hidden account was never hidden. It was protected. Protected by the same architecture that every modern hedge fund has built, optimized, and scaled. The architecture of algorithmic trust, a system so sophisticated that it convinces everyone inside it that nothing can escape. And when the silence comes, no one asks why. So the question is not whether another Barings will happen. It is whether you will be the one who hears the silence or the one who fills it with noise. The phone was silent, and the phone is still silent. But now you know what the silence means, and that knowledge is the only edge that cannot be modeled, cannot be detected, and cannot be taken from you.